of the firm's various milestones, including the spearheading of Prime Philippines' branch expansions in Davao in 2017 and subsequently in Cebu in 2020. She's also successfully executed numerous high-value transactions and facilitated the expansion of both local and international retail brands, corporate offices, and industrial occupiers across Luzon, Visayas, and Mindanao.
Thank you, Mimi. Good afternoon, everyone. It's great to see so many familiar faces here with us today. You know, people who have one way or another witnessed how our real estate landscape has evolved over the years. And as we take a step back, not just to review last year's performance, but to reflect on nearly a decade of real estate trends, I am pleased to open our sectoral outlook with what was once considered a sleeping giant, a sector that was unexpectedly awakened by a crisis nobody saw coming, the industrial sector. So let me start with a simple observation that I think most of you would agree, no? Warehouses didn't just survive the last 5 years. They quietly became one of the most resilient real estate assets in the country. What the data on the screen shows is a clear arc. Pre-pandemic growth, pandemic era resilience, and post-pandemic evolution, together pointing to demand that is structural and not just cyclical. So before 2019, warehouses largely operated in the background. They were back-of-house assets, but from 2022-2023 onward, they became mission-critical infrastructure, no longer just for storage, but rather for speed, fulfillment, and network reach. Even before pandemic, growth was already accelerating on the back of rising e-commerce penetration in our country. During 2020 and 2021, while most real estate sectors stalled, industrial assets remained operational, and post-2023, warehouse usage expanded even further, supporting fulfillment, last-mile logistics, and manufacturing supply chains. So, what we're really looking today is not just your ordinary warehouse story, but a supply chain transformation story. So, so what does that transformation look like at a top line level? No? Okay, so this chart shows a very clear pattern. Warehouse supply has grown steadily over the years with a much sharper acceleration from 2020 to year 2025 compared to the earlier period pre-pandemic, reflecting long-term confidence in industrial demand. In 2023, the market hit peak tightness with occupancies reaching around 98.2% and an average lease rates at about 250 per square meter, driven largely by occupiers shifting into newer, higher spec warehouses as central distribution hubs. As more supply was built nationwide, occupancy normalized to about 97% in year 2024-2025, and the rates remained firm, averaging from 230 to 250 per square meter. Supported by demand that didn't just come from a single sector, as also mentioned by Sir Jet a while ago, wholesale, e-commerce, logistics, and manufacturing all contributed, with companies decentralizing into multiple locations instead of relying on one large centralized hub, supporting both the absorption and the pricing. Next slide. Okay, so while the top line numbers show sustained growth and resilience, it is important to understand where that early momentum actually came from. So the industrial boom didn't start during the pandemic. It was already building years before that. No? So you'll see here how early industrial supply clustered heavily along the Calaba corridor or the Cavite-Laguna-Batangas corridor, driven primarily by manufacturers and the semiconductor industry. Track bans, decentralization initiatives, and the expanding role of investment promotion agencies, who are actually here with us today also, pushed warehousing activity out of Metro Manila, accelerating spillover into more developed provinces and southern and northern Greater Metro Manila. In 2019, the entry of e-commerce giants like Lazada and Shopee, and now we already have TikTok, Temu, Shein, stuff like that, no, have permanently changed warehouse usage. introducing fulfillment facilities, not just traditional storage. So this is when industrial parks in Laguna, Cavite, and Batangas evolved from optional locations into strategic infrastructure and actually set the stage for everything that followed during the pandemic. Next slide. So that foundation mattered because when the pandemic hit, it determined which sectors froze and which ones kept moving. So while most real estate sectors paused, warehouses stayed open. As you can see in the chart, logistics and 3PL players became the dominant driver, accounting for almost 90% of warehouse take-up in 2020 and nearly half of total demand in 2021. Demand remained stable, driven by online retail and logistics. In Greater Metro Manila, typical requirements range from 2,000 to 500 square meters, while Metro Cebu and Metro Davao were about 1,000 to 3,000 square meters spaces, no? Clearly favoring satellite facilities over mega distribution centers. Next. Okay, so talking about the demand resilience translated directly into occupancy performance. So as you can see here, warehousing occupancies remained stable nationwide. This stability was driven by sustained utility from logistics and e-commerce locators. West Cavite recorded the lowest occupancy at 68%, caused by new completed spaces in Trece Martires and the entry of Cavite Technopark. At the same time, brands like IKEA and major discount retailers weren't just opening stores. They were actually securing logistics footprints early, reinforcing baseline warehouse demand. On our end, our industrial team has actually been closing build-to-suit warehouse transactions ranging from 15,000 to even up to 40,000 square meters, not only within established industrial hotspots, but increasingly across emerging cities, such as in Nueva Ecija, Pangasinan, Bicol, Tacloban, even far-flung areas of Cebu, and even as far as CDO, Davao, and Digos in Mindanao, as occupiers plan for long-term expansion. Next. Okay, so now, as we move out of the pandemic period, the story shifts, no, from resilience now to discipline. So, since 2023, warehouse requirements have increasingly shifted into Bulacan and Pampanga as vacancies in northern NCR tightened. Okay, Pampanga in particular gained traction as more PEZA registered developments came online or expanded. You'll also notice a post-pandemic dip in Batangas area, driven by new supply coming on stream ahead of committed take-up rather than demand weakness. No? So at the same time, occupiers prioritize locations closer to NCR for faster distribution and transport efficiency, temporarily favoring still the areas of Laguna, Bulacan, and Pampanga. So demand going into 2025 continues to be led by manufacturing, retail, and the third-party logistics companies, with requirements generally growing larger as distribution and production networks expanded. More importantly, demand for high-spec warehousing became the norm. Higher ceiling heights, stronger floor loading. You know, before the requirements of our clients would range from 2,000 to 3,000 PSI. Now, it has increased to 4,000 to 5,000 PSI. And proper loading bays are now baseline requirements, no? As these occupiers are future-proofing their operations. Okay, so building on the demand shifts we discussed earlier, okay, the clearest signal now shows up in the pricing of these warehouses. Across key industrial provinces, warehouse lease rates have appreciated by up to 30% compared to pre-pandemic levels, driven primarily by the market's shift toward higher spec requirements. No wonder why in our poll a while ago, many of you have voted to invest in the industrial sector, probably because of these numbers. So Cebu leads the market with 2025 lease rates reaching around 270 per square meter, up sharply from about 214 per square in 2023, supported by grade A completions, the landlord confidence in the area, and the rising construction costs. Bulacan and Pampangas recorded the highest average rate of change, though growth is still expected to moderate as new supply comes in. Okay, so let's talk briefly about the cold storage. Cold storage is one of the clearest examples of structural demand within the industrial sector. As shown on the slide, national cold storage supply has expanded by over 35% since pre-pandemic levels, driven not by short-term cycles, but by long-term demand from food security, pharmaceuticals, export-oriented logistics, and temperature-sensitive distribution. What's particularly notable is that last year, 2025, marks the strongest year of realized supply growth in at least the past decade, with total capacity reaching around 1.2 million pallet positions. Importantly, this growth is backed by completed developments, not speculative pipeline assumptions, with expansion occurring across both Luzon and key Vismin markets. Next slide, please. Okay, so if the earlier slides explained why industrial strengthened, this slide is about where that growth is heading. Okay. So what you're seeing here is the geographic rebalancing of industrial activity. This rightmost part of your screen is actually like a cheat sheet for those who are looking forward to expanding your footprint. No, we also have it in our publication. So beyond the traditional hubs, growth is expanding into emerging corridors as developers and occupiers factor in flooding risk, congestion, and operating resilience, favoring nearby, lower risk locations rather than moving far from established markets. Okay, in terms of the industrial park, Laguna remains the country's primary industrial park hub, anchored by mature PEZA estates and strong connectivity to Metro Manila. Cavite, on the other hand, has emerged as the key expansion market, accounting for around 60% of newly PEZA-accredited developments in 2024 to 2025. Next slide, please. So, given all those information, where does this leave us heading into 2026 and beyond? Total nationwide warehouse supply is projected to still grow by 4 to 5% annually in the next 2-3 years, reflecting continued confidence in long-term demand rather than speculative expansion. Next, build-to-suit developments in emerging markets will continue to happen in the next years, thereby increasing land values in those priority areas. At the same time, lease rate growth is expected to stabilize at around 2% per year, supported by higher spec benchmarking and a more disciplined leasing environment. And as new supply gets completed, nationwide occupancies are expected to normalize toward the low 90% range, which is still a healthy level for a market transitioning into maturity. Okay, so let's be clear that in the industrial sector, we are not expecting an oversupply. It's a clear signal of a maturing institutional-grade industrial market. You know, at the end of the day, the industrial sector is no longer just about space. For those of you who are into industrial development or those who are looking to also venture or grow their footprint in the industrial sector is now all about readiness and future-proofing. The next cycle will favor those who will build the right warehouses in the right locations and at the right purpose. So therefore, the future of industrial real estate isn't about more warehouses. It's actually about building better, smarter, and more operationally relevant spaces. Thank you.
Thank you once again to Ms. Ruth for that presentation. Moving on to the office sector, it will be discussed by Mr. Mervin Valenzuela.